What is the best option to fund our expansion strategy? We are going to prove that by using shares, we are going to be using our best method of raising capital. But before we do that, let's take a look at our company today. Latin Pharmaceutical Company. As you already know, we are a company which specializes in chemical compounds, and 25% of our sales are in the pharmaceutical division. We are focused both on developing and selling products. We are coming from a rough year. Our sales are 10 million down from our sales of 82 million in 1993. Yet, our net profit is 1 million up to 6.6 million in 1994. And we are looking at a very promising market in recovery. However, there is one problem. We have debt payment on our principal in June 95 of 11 million. And our expansion strategy will require additional $19 more million. It also seems like in 1996 we're going to be looking at another 15 million expansion of capital. That's why we need to take careful consideration in the method in which we are going to be raising these funds. And because of that, let me present you the alternatives.
As you already know, we need 30 millions, and I'm going to tell you how to obtain them. We have two main alternatives: to make a common share issue or bond writing. In the first case, we need to issue 2 million shares, getting $50 per stock after the commissions. We will end with 9.3 million shares after the issue, giving $0.6 per share dividend for a total of 5.58 million dividends. We can also proceed with a bond writing, which will be of 15 years term with 4% interest rate. Payment of the cap principal will be 2 million with a 2-year grace period, which will leave a last payment of 4 million. We will proceed with the analysis of each option through 5 key financial measures. The first question we will need to ask ourselves is if it's the best time to issue common shares. The current book value of our stocks is 8.56 per stock share. If we issue more common stocks, we will increase both the equity and the number of shares we have. So the final book value will be 9.94 per stock share. In the other case, if we write bonds, both the current book value and the final book value won't be affected because we won't get more equity, nor we will increase the number of shares. The current value in the market is 19.75, which will lead us to think that it's a great moment to issue common stocks. Yet the market has been really unstable and the share price is expected to fall. So our best option is to write bonds.
What is the best alternative in terms of profitability for our shareholders, and how do we measure it? The key is profit per share. In the bonds option, the profit per share, it would be 82 cents per stock. That's because the number of stocks in the market, it would stay equal. On the other hand, in the common stock alternative, the profit per share, it would be 64 cents per stock. That is a difference between the two options of 17 cents. That means 20% less for our shareholders. Therefore, our best alternative in terms of profitability, it would be the bonds option.
Losing ownership. Nobody wants this to happen, and I believe that our shareholders will not be quite happy about it. The loss of control is a big issue that we have to address when talking about issuing new shares. Bonds will be the logical option because control remains unaffected. However, stocks is not a big issue and it doesn't seem like a bad alternative. Yes, 22% will be diluted amongst the new investors. However, remember we have the preemptive right, and this is the right to purchase new shares in the proportion that you previously had. On the other hand, even if the new investors or the actual shareholders don't want to purchase the new stock, we have to know that the previously issued shares are heavily diluted amongst the market. In conclusion, bonds is the logical best option. However, we should keep an eye on stock. It's not as bad as it looks.
Hi, as a financial risk manager, I want to present you another financial alternative option, which is called default risk. For common stock options, we need to evaluate the capacity to cover our payments for dividends. For bonds, on the other hand, we need to check the capacity and risk for payments or for interest. Here we present several years for 1995, 96, 97, where we evaluate the capacity, sorry to be compared with the same word, but we can see that we have 2 times the ability to pay for our debts. On the other hand, for bonds, we also have the same option, about 2.2 or 2.4. This would tell us that both options are good for us. They don't present risks in order to be against our payments. So maybe this is not the best option to choose, but we can conclude that both options can be viable for any of our best choices.
Talking about flexibility, for the following years, Pharmaceutical will need new financing in order to continue with the plans of growing. At the time we compare the emission of common stocks versus bonds, we have common stocks as our best option. Our current leverage level is higher than the industry. That's exactly why Pharmaceutical has to emit common stocks in order to be competitive. The new level of leverage in stocks, 0%, gives the company the capacity to react in the short term. Stocks makes the company more attractive to new capital. We could make better deals with banks and investors in order to finance our projects. Having less obligations in the short terms makes the company attractive to new stakeholders. That's because we can pay dividends. In contrast, with bonds, we could raise our leverage level 12 times higher than the industry level.
As we already saw, many financial aspects favor bonds writing as our main way to raise new capital. However, expansion will continue to demand capital in the following years. And as we already know, writing bonds will compromise our position in terms of flexibility. This means that if we are going to be needing $50 more million in 1996, we will be having some difficulty convincing investors or banks to issue more debt and to trust our company. This means that issuing shares is our best option to raise new capital, since bond will put us in a very complicated position. We hope that this presentation will help you make up your mind and decide to issue shares for our expansion plan and to pay the principal we need to pay in June of 1995.